So today we're going to look at the different depreciation schedules and the four major methods of calculating depreciation for book depreciation. Tax depreciation can be a little bit different, although some of the same methods can be used. So in this case, let's say we have a dump truck. We have a cost of $64,310, an estimated residual or salvage value of $5,000. An estimated useful life of 10 years or 125,000 miles. This dump truck was purchased on January 2nd, 2019, and our general rule with depreciation is that if we purchase an asset prior to the 15th of the month, we count the entire month. That's for book depreciation. Tax depreciation has some different rules. This is one of the only areas where you can do something different on your books than you can do on your taxes. So we know we're going to count the whole month of January. We're going to do the straight line method, units of production, okay, and the units have to be given to you. Double declining balance, which is an accelerated depreciation method, as is some of the year's digits, which is kind of antiquated, but it's included in your workbook, so we're going to go over it. So in order to do the straight line method, okay, it's the easiest one and the one used by about 3/4 of American companies for their book depreciation because it's easy to do. So what we're going to look at is the 10 years first. So our year is 2019, 2020. And on Excel, you may know you can create a series and then you can just use the autofill. We don't really need the rate column on straight line. If you want to use it, you can. It would be 1/10, because what we're basically doing is we're depreciating 1/10 of it each year. So it's going to be the same every year. So what we're going to do is we're going to take our cost of $64,310. We're going to subtract the estimated residual or salvage value, $5,000, and then we're going to divide it over the 10 years. That's straight line depreciation. It's pretty straightforward, no pun intended. So we're going to get $5,931 per year. And again, here's the formula, and it's going to be the same each year. So all we need to do is just drag it down. So we know that it's going to be $5,931 per year. So if we're going to journalize the first year's depreciation under the straight line method, we can go to our journal down here, and we're going to say, we'll just put the year in there, 2019. Now we're having some formatting issues here, so let's just put in 12/31. And we're going to debit depreciation expense for $59.31, and we're going to credit accumulated depreciation. Right? And that's for the dump truck. And we're going to say this is straight line. Straight. Okay. Now, so it will be the same entry every year until the asset has been fully depreciated or sold or junked or something else. Okay, now if we go back to the schedule, the accumulated depreciation in the first year is going to be the same as the expense because it would have started at 0, right? So we could just type that in. Now the second year, it's going to be the first year plus the second year. Accumulated depreciation is essentially the accumulation of all the expense over the life of the asset. So what we're going to do is we're just going to press equals. We're going to take our $59.31 plus the next year's depreciation expense. So we took the depreciation expense for year 1, which was 2019, and we added year 2, which is 2020. Once we do that, we could just copy it down, right? So there's the 59,310. Okay, that's the depreciable cost, right? Cost minus the estimated residual or salvage value. Now, at the end of its useful life, the book value should equal the salvage value or residual value. So book value, if you recall, is cost minus accumulated depreciation. So the cost is the 64,310. So we need to type that in and then subtract accumulated depreciation. So our book value at the end of 2019 is 58,379. It should be 5,000 at the end. So now we can just copy this down. And it is. So the straight line method is, more or less pretty easy, right? You just got to remember the different calculations. Now, when you get to the units of production method, we do have to use this rate column because basically what we're doing is we're trying to figure out a rate per unit. In this case, our units are miles, okay? Because we were told that our estimated useful life in units is 125,000 miles. So we can copy the year now. Let's do that first. Okay. So somebody would have to estimate the units. An expert in this kind of vehicle would have to kind of give us an idea of how many units per year it would be used, or perhaps there would be sales projections that might tell us that. For now, we're just going to be given the information. Now, in order to get the rate, what we have to do is we have to take the cost of the 64,310 minus the estimated residual value or salvage value of 5,000, and we need to divide that over the number of units that we are going to use. So this is our estimated useful life in units. So it needs to be over the 125. And basically what it does is it gives us 47 cents per mile. Okay? So once we have that, we could just copy that down. That's going to stay constant throughout the life of the asset. Unless there's a change of some kind, like we add more trucks, we upgrade the truck, we sell it, we junk it, whatever. But assuming that nothing changes, that would be our rate. So our depreciation expense simply be the rate times the units. So we would take our rate of 47 cents per mile times the number of units, which are miles in this case. And our 2019 depreciation would be 71.17. So it'll be a little bit higher than under straight line. So this is probably more accurate for this type of asset because it's based on usage. So if we're going to do the journal entry, okay, for the first year depreciation expense for units of production, we go back to the journal, we're going to use the same two accounts. This will be 1231. But now it's going to be 7117 instead of 5931. And this would be units of production. So you can see the method you use will affect your expense and ultimately affect net income. Okay, so again, certain types of assets, units of production is more accurate. Okay, just because you're determining it based on use. If you're talking about a desk or a couch, straight line is probably the better option. So here we can just copy, okay, and you can see that every year of depreciation is based on units. This one here is the same as straight line, it's just a coincidence, okay. So our accumulated depreciation, again, is going to be the first year depreciation expense for our first year of accumulated depreciation, right? And then the second year, we're going to take the depreciation or the accumulated depreciation for the first year, and we're going to add the second year's depreciation expense. Okay, and then we could do the same thing. We can pull it down. Okay, and book value again is cost minus accumulated depreciation. So again, our cost is 64,310. So we're going to take the 64,310 and subtract the accumulated depreciation. So again, when we get to the end, our book value has to be 5,000 because that's our salvage of residual value. Okay. So we'll copy this down, and it is. Okay, so what we'll do in the next video is we'll do the other two depreciation methods. Thank you for your attention.